So you're looking at the stock market, and it's just a sea of companies, right? Thousands of them. How in the world do you start comparing one to another? It can feel pretty overwhelming. But don't worry, investors have some secret weapons, and they're called financial ratios. Today, we're going to crack the code on one of the most famous ones out there, the price-to-earnings ratio. But first, before we dive into the numbers, let's talk about a classic trap that a lot of people fall into. I like to call it the $10 stock myth. Okay, picture this. You've got two companies. Company A has a stock price of $60 a share. And then there's Company B, trading at just $10 a share. Now, just looking at those two numbers, which one feels like the better bargain? Your gut instinct might be screaming the answer. Yeah, a lot of folks would jump on that $10 stock. I mean, it's cheaper, right? You could buy 6 shares of Company B for the price of just 1 share of Company A. But, and this is a huge but, that's not the whole story. In fact, that line of thinking can be a real trap. A stock's price tag tells you almost nothing about its actual value. Let's just say it one more time so it really sinks in. A low share price does not mean a stock is a bargain. So if the price tag isn't the answer, what is? Well, this is where the hero of our story comes in, the price-to-earnings ratio. You'll usually just see it called the P/E ratio. This is the tool that lets us make a much smarter comparison. So what is this thing? Thankfully, the name pretty much says it all. The PE ratio takes a stock's price and puts it right up against the company's earnings, its profits. Think of it this way. The PE ratio answers one simple but really powerful question. For every single dollar the company earns in profit, how much are investors like you and me willing to pay for it? It helps us see if a stock price is actually a good deal compared to the money the business is actually making. All right, theory time is over. Let's put this P thing to work with our two companies. And to make this super clear, we're going to use a little analogy. Let's imagine both Company A and Company B are in the snow shovel business. Simple enough. But here's the twist. Company A is located in chilly Wisconsin, where they get tons of snow. Company B, it's down in sunny Texas, where seeing a snowflake is a major event. Keep that difference in mind because it's going to matter. To find the PE ratio, it's actually a pretty straightforward two-step process. First, we need to calculate something called earnings per share, or EPS. And once we have that, we can easily figure out the PE ratio itself. So what is this EPS thing? It's really just the company's total profit divided by the number of stock shares out there. It tells you exactly how much profit is behind each and every individual share. Okay, let's plug in the numbers. Look at Company A, our Wisconsin shovel company. It earns $100,000 and has 50,000 shares. That gives it an earnings per share of $2. You take its $60 share price, divide by that $2 of earnings, and you get a PE ratio of 30. Now let's look at Company B in Texas. It makes $10,000 in earnings with 10,000 shares. That's an EPS of just $1. At its $10 share price, its PE ratio is 10, and that is a huge difference. So yeah, Company B had the lower stock price, but the number that really jumps out here is its PE ratio of 10. That's way lower than Company A's 30. And here's why that matters. That lower PE means Company B might just be the better value. Why? Because with Company B, you're only paying $10 for every $1 of profit it makes. With Company A, you have to shell out $30 to get that same dollar of profit. So low PE is good, right? Case closed? Well, not so fast. It's never quite that simple. A low PE doesn't automatically get a green light. We've got to look beyond just the ratio to get the full picture. You see, sometimes a stock is cheap for a very good reason. Just think back to our snow shovel company in Texas. Sure, it has a low PE, but what's its future look like? It's kind of stuck, right? There's a natural limit to how many snow shovels you can sell in Texas. That low price might just be reflecting the fact that there's not a lot of room to grow. And on the flip side, a high PE isn't automatically a red flag. Sometimes it's actually a sign that investors are super optimistic about a company. They expect its profits to grow, and grow fast. Let's go back to our Wisconsin company for a second. What if they just invented a game-changing, self-pushing snow shovel? I mean, wow, that kind of innovation can make their earnings explode. If that's the case, investors might be totally fine paying a premium, that high PE of 30, because they're not buying the company as it is today. They're betting on what it's going to become tomorrow.
All right, let's wrap this all up. What are the big things to remember? 1. The PE ratio is a fantastic tool for comparing what you're paying for different companies. 2. Never, ever assume a low share price means a stock is cheap. 3. Context is everything. A low PE can mean low growth, and a high PE can signal big things to come. And finally, and this is maybe the most important, the PE ratio is just one tool in a very big toolbox.
So, while the PE ratio is an awesome starting point for figuring out a stock's value, it should never be the only thing you look at. Which brings us to a final thought. If the PE ratio is just one piece of the puzzle, what are the other pieces you need to get the full picture? And that, well, that's the next step on your investing journey.